Well, welcome back to Financial Accounting. The purpose of this little mini lecture is to review the multiple choice component of the exam number 2. You may recall from the other day I said that there were 40 multiple choice questions, and the maximum number of points you could have gotten for this section was 50 points. So I took the number you got correct, divided it by 40 and multiplied by 50%. And that gives you your first number. And then on the rest of the numbers on your first page of the exam would be the number of points you scored for take home question 1, question 2, question 3, question 4, question 5. So there were 5 take home questions, each worth 10 points. So what I'll do is I'll go through each question, each multiple choice question, talk about the solutions. And if there are computations involved, I will show you the computations as well. So there's a combination of definitional stuff and computational stuff. So the first one, the total amount of cash paid to a seller for merchandise purchased for consumption would normally include the list price plus the sales tax. So the cost of an item purchased for consumption would be both the cost of it plus whatever sales tax you had to pay for that. So the answer there is C. Number 2. Cumberland sells $2,000 worth of inventory, and they paid $12.50 for the merchandise. Under the perpetual system, which of the following journal entries would be made? So whenever under the perpetual system, when you record the sale, you also have to record the cost of the sale. So there's 2 entries here. It'd be a debit to cash for $2,000, credit to sales for $2,000. And then you would also have to recognize, since the perpetual system, the cost of goods sold based on the cost of the item. So that'd be a debit to cost of goods sold, $12.50. And a credit to the inventory for $12.50. Number 3, if the title to the purchaser passes to the buyer when the goods are shipped, well, the definition of free onboard shipping point is when title transfers when the goods are shipped. So that is called free onboard shipping point. The alternative to that would be free onboard destination, where the title would shift to the shift from the seller at when the goods actually arrive. So the answer there is B, free onboard shipping point. Number 4, a physical inventory at the end of June indicates, on this one, and a couple of you asked me about this during the exam, I gave everyone the correct information. All of you got this one correct because there was information that was missing here. You don't have enough information to answer that question. So I gave you all credit for that one. So only way you could figure out the cost of goods sold is if you knew what the beginning inventory was, what the purchases were, and what the ending inventory was. And they didn't give us all that information, so you couldn't have possibly answered that. So you all got that question correct. Number 5, where are selling expenses found on the multiple step income statement? Multiple step income statement would show sales minus cost of goods sold gives us gross profit. And then you subtract out the selling and administrative expenses, and that's where you get the income from operations. So the correct answer there is D. After where does selling administrative expenses show on the multiple step? They show after the gross profit. Number 6, company uses the periodic system for inventory. So you have to take, and they tell you what the inventory was on hand at the beginning of the period. They tell you how much was purchased, and they tell you what the ending inventory was. How do you figure out the cost of goods sold? Well, look at the numbers down at the bottom. Cost of goods sold under the periodic system would be beginning inventory plus purchases. That gives us goods available of $845. Subtract out the ending inventory of $160, and that gives you cost of goods sold at $685. Number 7, to encourage a buyer to pay before the end of the period, the seller may offer what's called a sales discount. That's the inducement you give to the person who buys the merchandise that you sell on account to pay you early. That's called a sales discount. So if we say 210 net 30, that means if you pay within 10 days, you're entitled to take a 2% discount. Following entry was journalized by the books of the Brighty company. So they debited cost of goods sold, they credited inventory, and they said this is a record to record the cost of the sold, the cost of goods sold. And it says, what is the effect of this on the accounting equation? So the effect of these on the accounting equation is you get a debit to cost of goods sold, and that's going to be a decrease in owner's equity. Anytime you have an expense, that's a decrease in owner's equity. And you get a credit to inventory. Inventory is an asset, so anytime you have a credit to an asset account, it's going to reduce that. So your correct answer is a decrease in assets and a decrease in owner's equity. Cost of goods sold reduces owner's equity, and the credit to inventory actually reduces the asset. So the correct answer there is D, as in dog. Number 9, assume that inventory on hand at the end of the period is determined by taking a physical inventory of $63,000. Excluded from the count were $6,000 which were in transit, terms free on board shipping point. Well, if it's free on board shipping point, that means that the title title transfers once the stuff gets to the shipping point. So we had a purchase of 6,000, and we had a physical inventory of 63,000. So the 6,000 that was free on board shipping point should have been included in the inventory. So the answer there is 69,000, which is 63,000 plus the 6. Number 10, Pierce Company sold merchandise account to Stanton Company, terms free on board shipping point. And again, free on board shipping point means once it gets to the shipping point, then the buyer has got to pay the freight. Terms were $210 net 30, and it was for $20,000. But we paid the prepaid shipping charge. So what Pierce has to do, Pierce has to record the sale of $20,000 by debiting accounts receivable and crediting sales. And the fact that they prepaid the shipping charge, they're going to get that eventually, like it should get that back from the person who buys it. So it'd be a debit to accounts receivable and a credit to cash for the amount of the shipping charge. So the correct answer there is B, as in boy. Number 11, the unit cost of goods sold is $28. Using the table provided, determine the cost of goods sold. Well, the cost of goods sold, assuming that they use the weighted average method here, you take the total of all the unit costs, which is $33, divide by the number of units, which is 3. So the weighted average cost of goods sold, it would be $11. And so the answer there is 11, and that answer is D. Number 12, applying the lower cost of market rule for each item of inventory would result in the total inventory value of the following items. So what you do on the lower the cost of market rule, you consider the lower of the cost of the market. So what I've done is I've highlighted here. In this case, the market is less than the cost. In this case, the cost is less than the market. So you take the lower of the cost or market. So in this case, of item A, the market is lower. And then for B and C, it's the cost that is lower. So the total amount of the inventory would be the total of 4,350 plus the 2,800 plus the 1,700 gives you 8,850. So the answer there is A. Number 13, during the taking of the inventory on December 31st, Barry's Bake Shop incorrectly counted its inventory as 350 instead of the correct amount, which is 280. Okay, so they incorrectly counted it as 350. It should have been 280. So what they've done is they've overstated the inventory. If you overstate the inventory, you overstate the assets. Therefore, and you also overstate the ending inventory. And if you overstate the ending inventory, it overstates net income, and net income results in an overstatement of owner's capital as well. So by overstating the inventory by 70,000, you overstate the assets, you overstate the capital, you overstate the income, all overstated by $70,000. So it should have been 280. They recorded it as 350. So the overstatement is 70,000. All these 3 items, assets, owner's equity, net income, are all overstated by $70,000. So the answer there is C. Number 14, basic inventory data for April 30th are presented for a business that employs the lower cost of market basis of value in the inventory. What is the amount of the reduction in the inventory attributable to the market decline? So what you have to do is you've got to bring the carrying value of the inventory down to its market value. So in each case where the market value was lower than the cost, I highlighted them. So you had here it was 150 market, and it had a cost of 150. So it was, we had to write down each item of $5, and there were 20 of those items. And for D, you had the market value was 55, the unit cost was 3. So you've got to actually reduce each of these items by $3, and there were 4 of those. So if you take 20, which was the number that you had for item B, and those declined in value by $5. and you take 40 of the next item, item D, and those decline by $3. So 20 times 50 plus 40 times 3. If you add those together, you get 220. That's the amount of the you would recognize as a loss in the value of the inventory attributable to the market decline. So the answer there is D. 15, which of the following of cost flow methods is prohibited under international financial reporting standards? International standards do not recognize the LIFO method. So the answer there is LIFO. 16, the excess inventory results in all of the following except. Notice the word except is underlined here. So excess inventory would result in A, tied up funds that could be used to improve operations. So it would result also in increased storage expense. It would also result in increased loss of damage. The larger the inventory is, the larger the possibility of having a loss on it. So by process of elimination, the answer is B, lost sales. So lost sales would be excess inventory is not going to result in lost sales because you've got plenty of inventory. The problem is you can't sell the inventory, so it's not going to result in lost sales. So the answer there for 16 is B. Okay, notice I've highlighted here, during a period of falling prices, the lowest balance sheet for amount for inventory. Normally, FIFO gives us the highest value for the ending inventory, but that assumes rising prices. When prices are falling, it's just the opposite. So if prices are falling, FIFO is going to give you the lowest value for the ending inventory. So the answer there would be C. Number 18, damaged merchandise that can be sold at prices below cost would be valued at net realizable value. Net realizable value, you take what you could possibly sell it, you subtract out of that the cost of selling it, and that gives you the net realizable value. And if you've got damaged inventory, which is going to be the net realizable value is going to be below the cost of that inventory, you're going to record it as net realizable value. So the answer, damaged merchandise should be valued at its net realizable value. So the answer there is A. 19, which of the following cost flow method matches the unit cost to the unit purchase? So this is, we don't make a cost flow assumption. We actually value, we match to the sale, the actual cost of the individual item. Remember in class I talked about when we sell a car, for instance, when you're negotiating with the car salesman, he or she's got the ticket that tells them what the price of the car is. So when you match the unit, unit cost of the item that was actually purchased to the item sold, that's called D, this specific identification. FIFO, LIFO, weighted average are all cost flow assumptions. When you do specific identification, you don't have to use a cost flow assumption. You actually match the sales item with the cost of the individual item. Number 20, the cost of an item of inventory is 60 and its replacement cost is 75. The amount the inventory should be recorded according to lower cost to market. You take the lower of the two. So the lower of the 260, last time I checked, was less than 75. So the answer is B. 21, entries are made to the petty cash account. The only entry you make on the petty cash account is when the petty cash fund is established. So you debit petty cash, you credit regular cash. And unless you increase the balance of the petty cash fund, when you make payments out of the fund, you're going to be debiting the individual expense accounts. When you're going to be reporting shortages in the fund, you're going to be debiting cash short and over. And when you're replenishing the cash, the petty cash fund, again, you're not going to be debiting cash, or petty cash, you're going to be debiting the individual expenses. So entries made to the petty, you only make an entry to the petty cash account of the choices given when you actually establish the fund. Accompanying the bank statement was a credit memo for a short-term note. So a credit memo means the bank put more money into our account. So if the bank put more money in our account, that's what we call that a credit memo. So what we would do as for that credit memo is that would be in addition to the balance per our records. It's already on the bank statement, but when you do the bank rec, it would be in addition to our records. So the answer there is D. 23, which of the following is a company control procedure? And the ones that are control procedures I highlighted: separating responsibilities of related operations, safeguarding inventory in locked storeroom, and requiring employees to take vacation. Those are all examples specifically of control procedure. Identifying sudden increase in slow payments. That may be something we notice, but that's not a control procedure. The operating style of management would be reflective of the control environment. So the ones that are control procedures are 1, 2, and 5. So your answer there is D. Cash equivalents include, now cash equivalents are not cash. So regular cash would be checks and coins and currency. Those would all, that is actually an example of cash. Stocks and short-term funds, short-term bonds, that's not a cash equivalent. So cash equivalent would include money market accounts and commercial paper. Remember, cash is something that's just like cash. So money market accounts and commercial paper would be considered cash equivalents. Commercial paper would have a maturity value of less than 3 months. So the answer there is C. 25, which of the following reflects an internal control, a weakness in the internal control or a weak internal control system? So A, B, and C are all good positive things. D, a single employee responsible for collecting and recording cash, that is a inherent weakness in the internal control. They should be a different person collecting and recording the cash. 26, a debit or credit memo describing an entry in the bank's account, maybe enclosed with the bank statement. An example of a credit memo, that's when the bank puts money into our account. So A, that bank is taking money out of our account. C, they're taking money out of our account. D, they're taking money out of our account. Those will all be debit memorandums. The only one that's a credit memorandum there is B. 27, procedures designed to protect cash from theft or misuse from the time it is received until it's deposited in a bank are called, those are the controls over cash. Those are called cash controls. And 28, which of the following is a reason that business bank accounts are part of the internal control measures? Well, the reason we have a bank account is we have an independent record of our cash transactions. So the answer there is C. 29, which of the following the best describes EFT? That's electronic funds transfer. And the reason we use those, and many of you have EFT already set up with your own insurance payments and so forth, it can process cash transactions at less cost than using the mail. So we don't have to incur the cost of writing a check. We don't have to incur the cost of mailing a check. So the best answer there is B. 30, what entry is required in the company's accounts to record outstanding checks? Well, outstanding checks, remember, those are checks that have already been recorded in the general ledger. They haven't been recorded on the bank statement. And it's only the adjustments that I make per my records that are recorded, are going to require journal entries. So what entry is required in the company's accounts to record outstanding checks? The answer is no entry is required. 31, indications that an account may be uncollectible include all of the following except. So customer closes its business, customer files for bankruptcy, customer cannot be located. Those are all things that would indicate that an account should be uncollectible. B, the customer is making small but regular payments. So that one really is, as long as the customer is making payments, then you're not going to assume that the account is uncollectible. So the things that we're looking for the one that is the exception. So the one that is the exception there is the customer making small but regular payments. All the other ones would be indicators that the account is going to be uncollectible. So the correct answer there is B as in boy. The collection of an account that was previously written off under the allowance method of accounting for uncollectible accounts expense. Now remember, under the allowance method, you're going to debit bad debts expense and you credit the allowance when you set up the provision for the allowance. When an individual account goes bad, you just debit allowance for doubtful accounts and you credit accounts receivable. So that has the actual write-off in account under the allowance method has no effect on net income for the period. So the answer there is C. 33, the stated charge used using the money of another party, we call that's the definition of interest expense. 34, a 6,060-day 12% note is not paid by the maker at maturity. So if a note is not paid, we say the note is dishonored. So it ceases to be a note receivable because it ceases to be negotiable. So it's going to be a debit to accounts receivable, and it's going to be a credit to the promissory note, or the promissories. And in addition to the $6,000, you're going to have to record the amount of the interest as well. Interest is $6,000 times 12% times 60 over 360, so you get $120 worth of interest. So what you're going to do is you're going to debit accounts receivable because the person who dishonored the note now owes you the $6,000 plus the interest. So it's a debit to accounts receivable, a credit to notes receivable, $6,000, and a credit to interest revenue for $120. So the answer there is D. 35, under the direct write-off method of accounting for uncollectible accounts, bad debts is debited when the account is determined to be worthless. So that's when, on the direct write-off, that's when you actually debit the bad debts expense. It's different under the allowance method. In the allowance method, you're going to debit bad debts expense when you set up your estimate of the amount that's going to prove the uncollectible. On the direct write-off, you're going to recognize the expense when the individual account proves to be worthless. So the answer there is D. Current assets are cash, that things can be converted into cash within a year, and they are listed in order of liquidity. So that's why we put cash first. It is the most liquid of the assets. The answer there is D. Allowance for doubtful account has a credit balance of $500 at the end of the year before adjustment, and bad debts expense is estimated at 3% of sales. So if you're using the estimate of sales, you just take the amount of the sales and you multiply, by this case, by 3%. You don't concern yourself with the beginning balance and allowance for doubtful accounts. You concern yourself with that when you're basing your bad debts expense on an analysis of accounts receivable or an aging of accounts receivable, not when you estimate it as a percentage of sales. So the answer there is C, which is, I got a typo here. It's 300,000 times 3% is 9,000. So it's not, I can correct it right now. 300,000. There we go. We'll get rid of one of these zeros. Okay, come on. 300,000. I got to get rid of the comma. This is working in real time here. 300,000, one more zero. There we go. 300,000 times 3% gives us $9,000. So the answer there is C. 38, a debit in the allowance for doubtful accounts. What that means, think of a little T account here. If you've got a debit for all the accounts that are written off and you got a credit for the allowance that you had set up, if you end up with a debit balance and allowance for doubtful accounts, that means that you had more write-offs during the period than when you previously estimated. So it's actually D, indicates that actual write-offs exceeded the previous provision for bad debts. 39, under the allowance method, when a year-end adjustment is made for estimated uncollectible accounts. So it's a good idea when they ask you a question like this to actually come up with the journal entry. So what we did, if we want to adjust the allowance for doubtful accounts at the end of the year, we're going to debit bad debts expense and we're going to credit allowance for doubtful accounts. So it says when this adjustment is made, a bad debts expense is an expense account. Allowance for doubtful accounts is an asset account or contrasted account. So of the choices given, this entry has no effect on liabilities. It's not going to it's going to reduce net income because you got bad debts expense. So that's wrong. Total assets are unchanged. That's wrong because the allowance for doubtful accounts is subtracted from accounts receivable. So you're actually going to end up with a decrease in the assets. So the answer there is D. And number 40, the two methods for accounting for uncollectible accounts expense are the direct write-off and the allowance method. Okay, so I hope you found that little review useful. I will also post the video explaining the answers to the take-home as well. So be well, everyone. I hope you appreciated that little review that I gave you. Take care, everybody. Adios, au revoir, hasta luego.